Hello and welcome to another episode of Conversations with Coffey with me, Guy Coffey, and today's special guest, Boris Katsnelson from Black Iron Advisors. Today, what we're going to do is demystify financing, M&A transactions, and raising capital for small businesses, mostly in the franchise space. With that, I'm going to turn it over to Boris to introduce himself, his background, and what he's doing.
Awesome. Keith, thanks for having me so much on the show. Really excited to have this conversation. Yeah, I am, I guess you could call me a finance guy turned business builder to back to finance guy. So I've been in undergrad at Emory, went into investment banking, large cap, bulge bracket, Wall Street type investment banking, family offices, then MBA from Wharton. Then got the bug to kind of get back into private equity, but then help turn around companies. So I did that in consumer products, franchising, which we'll spend a good bit of time touching on, both as a franchisor and a franchisee in two systems. Then I did some work in consumer products again, in e-commerce specifically. And then I did some stuff in real estate before sort of turning back into kind of core finance, which is what I do now with Black Iron Advisors. And we're a boutique investment bank. We are focused on what we call the lower middle market, which is kind of $1 to $7 million EBITDA companies or cash flow. Typically that translates into, I say, 8 to 80 of revenue, million of revenue. But we really like to serve people freely. So I tell friends of mine, even though maybe your company or your friend's company may not be the size that fits for us, we tend to like to serve entrepreneurs, and that's where our hearts are. And our model is very much aligned with that entrepreneur, which we'll get into a little bit more later. But we like to bring, the breadth of experience that we have in the industry. So I tend to spend a lot of time in franchising, given the experience, and also consumer products and in blue collar trade. So that's where we spend the bulk of our time at Black Iron.
Well, what a background. I mean, someone that was actually in the trenches and not just looking at it from a financial perspective, which can kind of be siloed sometimes. And maybe you're not so familiar with the operational aspect or the marketing or things like that. You've been on both the franchisor and the franchisee side. I know you've actually worked with Speed Pro, correct?
Correct.
Tell us a little bit about that, just so we can get a flavor for your experience in franchising, because I think that really kind of speaks to your ability to walk in the shoes of the people that you're representing now. And I think that's a big deal. And it's a big differentiator, because the most of the people that I've worked with in this kind of thing is they've never been in the franchisor or franchisee side. But tell us about your experience.
Yeah, absolutely. So in 2014, I kind of had a bug to go and buy and run a company. So I had come off of a consumer products company where we helped turn that business around and had some great wins there. And I wanted to move the family back to Colorado, where we know each other. A great place to be, obviously. And kind of the first deal that crossed my desk was not Speed Pro, but it was a franchisor. And I just really fell in love with the space, the way to, help entrepreneurs scale and grow their business, where we can provide the systems, the branding, the tools, all the things, right, that go into being a great franchise brand. And then, a couple of months down the line, we got introduced to Speed Pro, which was, we're a sign and graphics business. So we had a little over 100 units at the time. It was in a area developer model, which means that, basically folks had territories that were typically states. Larger states were chopped up a little bit finer. But they would, help recruit franchisees, support them, and also operate their own location. And Speed Pro really did, vinyl graphics, but also it transformed into printing on large materials, like even wood panels that would go under a flatbed printer, all kinds of stuff. Great big graphics is the tagline. While we came up with that while we were there with a marketing agency, and it's still the tagline that's used today. So really fun ride. We grew that business to 135 locations. We had put a lot of systems in place there that the founder had really kind of one of these opportunities where that model that I was pursuing, it's called entrepreneurship through acquisition, which is quite popular these days, was to, a business owner was ready to retire, and I was kind of the younger guy ready to step in with some, MBA tactics and techniques to kind of go grow and scale the business. And that's what we did. And so I ran that for 3.5 years as CEO, and then sold my equity to my partner, family office, and helped recruit my successor. So it was a good outcome for everybody.
Nice. What a quick ramp up on the learning curve, I'm sure.
Yeah.
And it sounds like it was a successful venture, and got it, understood a lot of things, put new systems in place, grew the value, sold it to someone you know, like, and trust, and moved on, right?
Yep.
That sounds like an outcome that a lot of people listening to this show would probably like. So I wanted to recap that for them, right? So, hey, so I wanted you to be on the show because we're friends, and you're wicked smart, and I knew that you could help us kind of demystify all the terms that emerging franchisors or franchisees, even some with multiple units, lots of units, they hear all the time, and nobody wants to look dumb ever, so they might not ask these questions. But I'm not afraid, so I will. I'll ask you to just give us, like, who are the players that are buying emerging franchisors or helping them out, in this process. It could be years ahead of time, right? Who is their most likely client, different stages of development, or maybe different industries, and what's the difference? And how could people have conversations with these people? So let's just take it one step at a time. So we have equity investors, we have debt options to raise capital. I think a lot of people understand the debt portion. A lot of it's driven by SBA loans for smaller deals. Obviously, with a $5 million cap, it's not going to be for the bigger deals. But then we talk about angel investors and venture capitalists and investment banks and private equity. Run us through those 4 things. And if I think it's something that I wouldn't have understood a few years ago, I'm going to ask you to summarize. So
yeah, for sure. Yeah.
Run through it.
So early stage, it's a lot of angel investors, which are a lot of times those are friends and family, quite frankly, that they know you, they trust you, they like you, but there's not a lot to show for the business quite yet, right? Like it's just hey, I've known Guy for years, and I know, like, and trust him, to your point, and I'll throw some money behind it. It's tough to value those businesses, right? In terms of, like, what is it worth? It's more of an idea. Maybe you've gotten a unit off the ground, but it's still very early days. It's not making a lot of money. There's not a lot of revenue so you've got friends and family, and there are some institutions that kind of play in the angel investing, and that sort of, I would also sort of morph into venture capital, which is venture capital is early stage investors. And there's, people that dive into that in a lot of detail. I'm not a venture capitalist. I've been more in the more advanced companies that are, more later stage, which is where private equity comes in, which we'll come back to. But venture capital, you hear these terms, seed stage, as you can imagine, those are early, right? Seed, then you get the series, and then there's the letters that come about, A, B, C, whatnot, right? It's all it is they just add letters to it, right? Like an Uber before they went public would have been like in a series, like towards the end of the alphabet, U type raises. I don't know exactly what it was, but normally it's ABC is what you kind of hear. Maybe you get to a D and E, but those are, when you're getting into those kind of rounds, those are venture capital firms. I haven't seen, quite frankly, many players in venture that get into franchising. There's one recent sort of exception to that was a client that we worked on last year. If I may, I'll tell you about that because I think it's a good way to exemplify it.
Sure.
It's a brand called Daisy, like the flower. And this brand was started by executives in franchising that had a lot of success. They saw a kind of a white space in basically smart home and putting a consumer brand around the smart home technology, right? We all have so many connected devices, internet goes down, you've got, audio systems, video systems, security systems, and none of us know how it works, right?
Right.
So Daisy came up with this idea that, hey, we want to go and build a brand around this, do it right. So they approached it from, let's go buy these individual mom and pops around the country, and build these as corporate locations, and then also franchise with greenfields as well. So our client last year is a friend here in Denver. His name's Gavin Lancey, Savvy Home. We can link to that in the show notes.
Sure.
And we helped him sell Savvy Home, which was a multi-million-dollar operation doing all those things in the Denver metro market. He had a couple of franchises. He had a lot of the systems built out to be do the greenfield franchising. And Daisy had, back to the venture capital side, they had raised venture money, and really because they had a plan. They had a plan to go and buy and roll up these groups like Savvy Home, others around the country, and to go franchise in a kind of a joint strategy. So they raised venture money to have a bit of a war chest to go buy companies, and then also have this greenfield operation and franchising. And so they raised, I think it was maybe a Series A round at that point, and got the capital to go do it. I would say not that common in franchising that I see is venture money. Most folks are kind of, later stage. They kind of get there on their own. A lot of franchises that I see, Guy, I don't know about your experience, but they tend to bootstrap a lot of the business, right? Mm-hmm. And frankly, this doesn't, people don't like to talk about this maybe as much in franchising, but initial franchise fees tend to fund a lot of the operations of a business, right? Yeah. The new franchisees coming into it. And that's just kind of the reality of the business. So anyway, I'll pause there, but that's kind of the way I think about venture, and we can talk about some of the other pieces.
Yeah. Venture, I usually equate more to tech, right?
Correct.
You know, Silicon Valley and, and the Bay Area and Boston, all those kind of, it's more, and then it seems to be more tech focused than most franchising. Correct. But there's one thing when you say rounds, I understand that someone can have a Series A, a Series B, Series C, or whatever they're naming them. And to be honest, that's still a little bit murky to me. Mm-hmm. So tell us about that. Like, so, whatever, choose a tech company. It doesn't even have to be franchising that maybe, like Airbnb or something like that. At one point, they probably had a Series A, like they went worked with someone like you, like an investment banking firm, put all their business case together, the market size, like lots and lots of data.
Yeah.
And usually those people have had some kind of success in the past. Like once you've had success in the past, it's way easier to raise money. I do know that.
Absolutely. Yeah.
And they're like, hey, I've got this. So one of our family members started a company and eventually it was the first organic baby food company, and they had eventually sold to Dannon. Right. So, super, super big exit, super successful. And then she had an idea for, another company, which we just saw a commercial for last night when we were watching Amazon Prime. It's called Love Every. It's like children's toys things.
Oh, nice.
And it was so much easier for her to raise money the second time around because she's a big hitter already, right?
Yeah,
and so
proven.
When she made that case, they're like, yeah, we'll do this. So like someone like that is like they raise their initial funding, and then why would they have subsequent rounds? Do they, like if someone didn't know, they'd be like, well, they ran out of money, so they needed to raise more money. And I'm sure that's not the case. So why would they have subsequent rounds?
Yeah, that's a great question. Yeah, right. So a lot of it in venture, which I would just in full transparency, not my area of specialty. We're more established companies, but I know enough to be dangerous, I would tell you, is that, normally venture capitalists like to fund a business to certain milestones effectively, like to prove out XYZ, right? In the case of, I don't know your family member exactly what they're doing, but they're, with Uber, it may be, we want to basically prove out that we can open in 3 markets, right? And so once we've proven that out and we funded that, then we want to go and open in 20, and then we maybe want to get into another type of service or things like that. So it's usually milestone based in my
Okay.
experience when they raise at different rounds, and also for the founders, there's dilution at every time you raise money, which dilution means I start out, if I'm the sole owner, I own 100%. I go raise money because I need to, give away equity and I need the capital to go execute on the plan. Now I sell, say, 20% of my company. Now I own 80, but I have, say, round numbers, $20 million in my pocket to go execute on it. Well, the next time, my valuation might not be, I made a big number to begin with. 100 million is way too, nobody's raises at 100 to begin with,
Right.
just for context, maybe at 10 if they've got some prior experience. But point is, right now I've proven out, like the Uber example, I'm in 3 markets. Now my valuation is going to go up to maybe $50 million. And now I'll sell, now it's a lot less dilution for me if I need 5 million to get to that next sort of stage. Then I'm selling 10% of my company. Whereas when it was a $10 million valuation previously, if I need 5 million, I'm selling 50% of my company, right? So there's sort of the give and take between investors wanting to see progress before they deploy capital and the entrepreneur also wanting to, dilute themselves less and sell less of their company. So there's a bit of that dichotomy going on, which is healthy, frankly.
Yeah. Okay. So I could ask more questions on that, but I imagine for the founder, which is the position I always think of think of as it probably becomes once there's more proof of concept and more momentum behind it, you can actually raise more money for less equity later on
Exactly.
once it's proven further. That makes a lot of sense.
100%.
So you wouldn't
100%.
want to, even if you knew you had this big number to raise, you probably don't want to do that in one big lump sum because at that point in time, it's going to cost you a lot more money. Okay.
Exactly.
That makes
Yeah.
sense. All right. Well, one thing that's cleared up in my mind now. So thank you.
Yeah.
And then we get to private equity, and that's the most that I see a lot of activity in franchising from private equity companies. Our own personal experience with selling Frenchies. Tell us about that, and how does that work, and what's good about that from the PE company's perspective and from the founder's perspective, and why does it happen so much in franchising, do you think?
Mm-hmm. Yeah, yeah. So that's where I've spent a lot of my career, right? So when I bought Speed Pro, we were effectively a private equity firm with a single asset purpose, right? Where I was going to go in and run it. The most traditional private equity firms that you see out in the market, common names that you see are Princeton Equity these days, right? Riverside, folks like that. There's
Rourke.
many others, and we interact with those guys all the time in what we do, and they're, that's what, we'll talk about investment banking, our role in this, but
Yeah.
private equity really, as an asset class, people, individuals, if you're a creditor, investor, or qualified purchasers, you can invest in private equity, and they pool capital from individuals, but a lot from, limited partners that are, the Colorado State Teachers Fund and the Firemen's Fund and whatnot across the country. And they pool this capital, and their goal is to go buy into a business. They typically use leverage, or another word for debt, to kind of, you could say juice their returns a little bit, meaning they're borrowing money at, say, even, 10% maybe in this market today, probably a little bit lower than that for bigger companies. And they don't have to put all equity to it, so it'll increase their returns. But they're really looking for ways that they can add value. What is quite common in a business, especially in franchising, is how do we grow the system, right? How do we grow cash flow to this, to the business? And then ultimately, maybe add, you see a lot of multi-brand players in a niche, that well with your Frenchies experience and what Riverside has done there. And you can talk to that better than I can, but, they're looking to, build a quote unquote platform. You hear that term all the time, right? So they
Mm-hmm.
want to build similar assets to aggregate higher levels of cash flow. And then you're sort of playing this game of getting to the next buyer tier, right? So there's where we sell entrepreneur companies that we consider lower middle market, as I said in the beginning, 1 to 7 million. Then then we'll sell those to private equity firms, and then they'll try to aggregate a bunch of assets, grow each individual one, and then get to different tiers, 10 million of EBITDA or 15 or 20, 25, so on and so forth. And we get to those bigger numbers, then you've got these, groups like KKR and Blackstone that play when you get into the 25, 50 million of EBITDA companies. And it's so that's sort of it. But what people like, to your question about franchising, is, as people would expect, right? Royalties are quite exciting for people, right? And the royalty revenue, that a franchisor, and that's part of what was my allure in buying Speed Pro, was we can do kind of the things at a group level, right? Where we can build a great brand, we can spend the money on systems and all these things to enhance our franchisees, who are the ones really doing the blood, sweat, and tears, doing the work, getting the clients, and those royalties go up as the average unit volumes go up, and more franchises, more dots on the map, and make them more successful. That's really the job of the franchisor. And when that works great, it works fantastically well. Everybody wins in that dynamic. And at the core of it, I think, when I look at it, is unit economics to the franchisee is so paramount in that realm. So I'll pause there.
Yeah, no, that's great. What we've seen, happen over and over again is, in most cases, the PE company comes in, they buy a franchisor, whether it's early stage or later stage. And if they have a platform company, they have shared services. They're much more professional. The biggest thing the biggest thing for us when we had our, and ours was not a gigantic deal by in the realm of these deals at all, but they treated it just like it was a big deal. Like, whether it was $100 million deal or our size deal, they have the same players involved. Like, the big law firms, the big accounting firms,
right,
the big auditing firms, because they don't really want to miss. And it's just easier for them to run a system the same way, whether it's a big deal or a small deal.
Totally.
And then they have, these super, like in our case, like emerging franchisor, like we're I hired a fractional CFO like 3 years before we sold, to help us prepare for sale and things like that. But before then, it was just us doing it, and all of a sudden you get everybody involved in the brand is usually like an Uber professional, and they have systems that, everybody does the same exact thing, and they can increase the value that way. And then, they put these systems in place that help the franchise system grow. And that usually is a benefit to the franchisees as well.
Yes.
Almost every time. So it's a good thing. Because sometimes you hear about like, oh, and then the PE company came in and, things were a lot different. Like, yes, they're different, but they're usually just more professional. And they help people make more money. Right. But everybody does get treated the same way. I think that's not always the case when a system is really small and growing. There's some exceptions that are made that actually don't help them in the valuation process, but it makes people feel more warm about it. So
private equity set up really to enhance value, right? To your point about what are they there? It can sound scary, big and scary. You see movies around greed around private equity and Wall Street, but you get down to it, they're humans. I was one. I think I'm fairly human and personable and all that.
You're a nice guy. I can vouch for you.
Yeah. and they're just people that are trying to create value for folks, and it's scale, it's systems, it's all the things that you mentioned, 100%. And that's where they're really at the core of it, as I'm mentioning, right? Unit economics to the franchisees is what they're trying to drive, and successful franchisees breed great validation for other franchisees coming in the system, growing unit economics, and everybody wins, right? That's where, it's, the old tagline in franchising is like, you're in business, for yourself, but not by yourself. Right. And exactly. It may be trite, but it's very true. And the systems that really work, they really, really do work well.
Yeah. And when an emerging franchisor gets purchased by a sophisticated PE company, you're dealing with a whole different level of support in terms of people, tools, processes. They can afford to buy the best, territory mapping system that's available out there that nobody as an individual, franchisor, when they're emerging, would ever be able to afford. So
right.
They have better tools, and they do things like this all day long, and they've done it multiple times. So not trying to sell people on selling to private equity, but it's generally good for the franchisees. And that's kind of the lens that we've always looked at things through, because if the franchisees do well, everybody else involved does well. And if they don't do well, dunzo. Like it doesn't last. It doesn't last at all. So tell me. Yeah. So it's, it's always a good thing. One of the things when I was going through this, because, even with, I had some experience in this, but there were certain things that I would hear or I would think about, but I wouldn't do because to be honest, I didn't want to look stupid. And a lot of people in the beginning, emerging franchisors or maybe franchisees that have, enough units that like, hey, this might be of interest to an investment group one way or another. I think because they don't have this experience in this process of valuation, of selling, and what the process looks like. And you hear it so much, you think everybody else around you knows everything about it. So one of the things that I learned from talking with you and my own experiences, like it's a conversation. Like you can have a conversation with a professional that does this all the time and learn so much. And I know that you have shared with Black Iron Advisors that you're working with people for sometimes years before they're ever actually even going to be ready to do a transaction, but you want to step in earlier, get to know them, maybe provide some guidance just from your own experiences and have this conversation. And I'm going to go back to how we started this out. Like the demystification of this is huge, and it can happen in some conversations. And I would encourage people to have these conversations because it gives you hear about it so much, and this is the exit that most people want to have, right? And having those conversations. So tell me, how does someone, obviously we'll have all your contact information and things like that, but in general, how has it happened before where someone reaches out to you for informational purposes, then it becomes a relationship, and then down the line, you become the person that's helping drive their transaction and getting the most value for their company? How does that happen?
Yeah, no, great question. I mean, usually we meet folks through referrals, or they see us, see me on a podcast, or someone that has known me for a while. Usually is how we'll get connected to someone, or they're like, oh, you should chat with Boris, because as you said, most people are, they don't do this every day. It's what I've done most of my career, whether I've been on the investment banking side or the private equity side. It feels comfortable to me because that's what I do, right? But most people, they're good at building their company, and they know that really well. And but we get introduced early, usually. Certainly we'll talk to people if they're ready now, but it's always great to start that process early on, because there are things that we can guide them on, in terms of what the market ultimately is looking for, because we're in those conversations, every week with quote unquote the buy side, which is what private equity is, right? So we can kind of give them that direction. Like we're working right now early with a multi-unit franchisee, has about a dozen units in a system, and he wants to ultimately not exit fully. And there's lots of ways to do it. You can sell 100% of your business, you can sell a minority stake, or you can sell somewhere in between, minority being under 50%. And there's different things that the market will be looking for, right? Certain level of maturity of those locations, right? So you'll get credit for having started locations, but you won't get full credit as if it's all the way at maturity, which maybe in this case might be 3 years, where I know you're in the fitness business, right? Your Planet Fitness, I bet you in 6 months is not doing the cash flow that it's doing in year 3 or 4, like no way near, right? Nobody knows you're there. You haven't built the membership base, things like that, right? So we can get in early and say, okay, what's your objective ultimately? And people, that may be, I want to work in a different capacity than I'm working today, right? Which may mean, okay, I need to bring in a team to basically, if I want to go away in 3 years and retire, then I need a senior leader in that company, so I'm not running that business again. Some people look at it in a combination of it as, say, I need a certain dollar amount, that this is my last, I'm in my 60s and I want this to be my last hurrah, and I need $10 million or $20 million to kind of, make it right. And we can say, okay, if 20 million is your number, then we may need to see EBITDA at this level to be really clear. And maybe you're 70% of the way there. So what do you need to go from, here to there? Right. And we can, provide also, we're the capital markets experts as part of the team that folks, put together, and we can be intimately involved in and quarterback a lot of that, but we'll bring an exit planner, a CPA, to the extent that our client doesn't have those folks, to really, round out the team with the right expertise to get them to their ultimate goal. And our play in this whole thing is just, we want to serve entrepreneurs well. We don't require official engagement or mandate along the way. We just simply say, look, we want to share, be helpful, bring the resources to bear, and bring you that capital markets expertise and tell you what the market's looking for. And then we'll check in periodically by, folks that are, exit planners or, prep for sale folks will kind of do that more coaching along the way. And then, we've just built a lot of goodwill along the way. And typically that works out pretty well because, we've gotten to know them really well, and we're not, we're not in their pockets the whole time, right? Which we get paid quite well when we exit and sell a company for somebody. But we want to be along for that journey, and again, no cost to the client. It's just, let's build that relationship and do it very authentically.
I would, I haven't been in the capital market expertise industry as long as you have, or at all actually, but I think that's pretty rare where you're willing to work with folks ahead of time, because when I, as you know, because you thought I was crazy, I ran my own process for selling Frenchies and went down the path with a bunch of different people. It worked out, but having access to that capital expertise, every business is going to be exited somehow. It's either going to be given to handed down generationally to a different, family member or something like that, or it's going to close, or it's going to sell, Sure. And so if you're building something, I think it behooves you to know what the market is going to look at it like, like what are the high points, and what are the areas that could kind of need a little polishing
That's right.
And so I think that's pretty rare because, I got quoted from a few different investment banking firms, not yours, a lot of money, so much so that I was like, well, I better try to do this on my own, and that was, it was eye opening, and,
right.
and some of the things that when I did my own process, some PE companies really liked our development pipeline, our sold not opens, and others saw it as a detriment to our value. Right.
Right.
And it's since it's your baby, you're like, oh my gosh, they called my baby ugly,
Right.
having someone in your corner. It's just like, no, like, I wish I would have had that, like someone like you. Cause like, no, your baby is ugly to that person, but like that same feature is going to be like a real selling point for other private equity companies. Cause it seemed like they all had their own checklist. And then one thing before we land the plane is here, is, you had mentioned PE is the buy side, right? So they are buying it. And the flip side of that is the sell side is the investment banker.
Correct.
I was in franchising for 10 years before I realized that. I just thought it was just like some investment bankers bought things and some private equity companies bought things. I didn't know that it was a different side of the transaction. So I hope this has helped our listeners. Obviously, I'm going to have all your contact information. So if someone's got questions and wants to reach out to you, which I encourage people to do, besides just being a nice guy, Boris is unbelievably smart and unbelievably experienced, not just in the capital markets, but also from the franchise side and a business operations side, which I think is pretty rare. So I would encourage you, if this is something that's going to be on your path at some point in time, have the conversation earlier, because that always helps for preparation. So Boris, thank you so much for sharing all your knowledge and your time with us today. Really, really appreciate you. And, if I can ever reciprocate some way, somehow, please let me know. But thanks again. Really appreciate your time and sharing all your knowledge today.
Yeah, it's been great chatting with you today. And yeah, like you said, we're happy to serve people and reach out if we can be helpful, and we'll let you know how we can best help you, or refer you to other folks in our network that we think are great for what you need at the time. And yeah, great to be friends with you, and look forward to more conversations.
Perfect. Thanks. Take care.
Thank you.